What happens when nearly $40 billion disappears from global stock markets in just 1 week? That's not a random question. It's exactly what happened recently, as investors rushed to pull money out of global equity funds. Is this a sign of trouble ahead, or just a natural pause after months of record growth? Today, we're breaking it all down: causes, effects, and most importantly, what it means for you. Understanding the basics. Before we dive into numbers, let's clear up what all this means. Think of global equity funds as giant baskets holding pieces of companies, called shares, from all over the world. People like you and me invest in these baskets, hoping that as companies grow, so will our savings. Now, when many people suddenly decide to pull their money out at the same time, that's called an outflow. Imagine a playground where everyone decides to leave at once because they think the fun might be ending. That's what just happened in the global stock market world. The massive outflow. What happened? In the week ending September 17th, 2025, something dramatic unfolded. Investors pulled $38.66 billion from global equity funds. To give perspective, that's the largest withdrawal since at least 2020. And it didn't stop there. U.S. equity funds alone saw a record-breaking $43.19 billion vanish in a single week. Meanwhile, Asia and Europe went the opposite way, actually gaining money. Asia pulled in $2.23 billion, while Europe saw inflows of $1.25 billion. Emerging markets, like developing countries, remained popular, attracting $2.75 billion for the 5th week in a row. So while headlines screamed about massive outflows, the story isn't the same everywhere. Some regions are losing trust while others are gaining it. Section 3. Why did this happen? There are 2 big reasons behind these massive outflows. Number 1, lofty valuations. The stock market has been on fire lately. The MSCI World Index has climbed nearly 36% since April 2024, reaching one of its highest points in years. But with this rally came extremely high prices. Here's the issue. Stocks are valued not only by their price, but also by how much profit the companies make. This is measured by something called the price-to-earnings ratio, P/E. A normal long-term average is much lower. But right now, the global P/E ratio sits at 19.9, its highest level in over 4 years. Think of it like this. If a toy normally costs $10, but suddenly it's being sold for $20, you'd hesitate to buy it. That's how many investors are feeling about today's stock market. Number 2, interest rate shifts. The Federal Reserve recently cut interest rates to boost the economy. Lower rates usually help businesses borrow cheaply and expand, which should push stocks up. But here's the twist. Many investors see it as a warning sign that the economy might be slowing down. So instead of buying more stocks, some decided to cash out their profits now, worried about what lies ahead. The sector shuffle. The outflows weren't spread evenly across all sectors. Some areas saw investors pulling money out, while others saw money rushing in. Technology funds, home to giants like Apple, Microsoft, and Google, lost a heavy $3.1 billion. Many believe tech stocks are overpriced after years of booming growth. On the other hand, industrials gained $2.06 billion, while gold and precious metals funds attracted $722 million. Even more interesting, gold and precious metals commodity funds saw $1.69 billion flow in, continuing a trend of strong demand for safe haven assets. This marks 16 out of the last 17 weeks of inflows into gold-related investments. Clearly, investors aren't giving up on markets altogether. They're just shifting to what they believe are safer bets. What about bonds and money markets? When investors leave stocks, they often look for safer parking spots for their cash. This time was no different. Global bond funds pulled in $12.2 billion, though this was still the lowest inflow in 10 weeks. Government bonds gained $2.75 billion, the highest in 17 weeks. High-yield bonds, which carry more risk, still saw $2.48 billion in inflows. Money market funds, which are considered the safest place to stash cash short-term, actually had an outflow of $9.12 billion after weeks of massive inflows. The takeaway? Investors are cautious, but they're not panicking. Instead, they're rotating money into areas that feel safer or more stable for now. The bigger picture. So, does this outflow mean the stock market is about to collapse? Not necessarily. Experts like Mark Hafel of UBS believe this might just be a healthy pause after such a strong rally. He even called it a period of consolidation, where markets take a breather before deciding on their next big move. History supports this idea. Big outflows often happen after strong rallies. Back in 2020, during global uncertainty, investors also pulled billions out, yet markets eventually recovered and even hit new highs later on. In other words, this could be a reset, not a full-on red flag. What this means for everyday investors? Now comes the most important part. What should you do if you're an ordinary investor watching these headlines? Here are a few key takeaways. Number 1. Don't panic. Short-term drops in the market can look frightening, but reacting too quickly often leads to mistakes. Selling everything in a rush may lock in losses you could have avoided. Remember, investing is a marathon, not a sprint. Staying calm gives your money time to recover and grow again. Number 2, diversify. Don't put all your eggs in one basket. Spread your money across stocks, bonds, and even gold. Stocks can provide growth, bonds offer stability, and gold gives protection during uncertain times. Diversification cushions your savings, so if one area struggles, the others help balance out your overall portfolio. Number 3, look for opportunities. When markets fall, it can feel scary, but falling prices often create bargains. High valuations make stocks expensive, but after corrections, patient investors can buy quality companies at discounts. Staying alert and prepared allows you to spot opportunities that may lead to strong long-term gains once the market rebounds. Number 4, stick to your goals. Always remember why you're investing. Are you saving for retirement, a future home, or education? Your long-term goals matter far more than short-term market dips. By focusing on your personal timeline instead of daily headlines, you avoid unnecessary stress and give your investments the chance to grow steadily. Number 5, rebalance regularly. If one part of your portfolio grows too much compared to others, consider rebalancing every few months. This keeps your risk in check. A simple analogy. Think of your investments like a garden. Stocks are the flowers, beautiful, fast-growing, but sensitive to storms. Bonds are the sturdy trees, slower to grow, but steady and reliable. Gold is like a protective fence. It doesn't grow much, but it keeps you safe when winds get rough. This outflow is like a storm passing through the garden. Some flowers may lose petals, but if your garden is diverse and balanced, it will keep thriving over the long run. So, what's the real message here? The recent $38.66 billion outflow from global equity funds shows investors are cautious after a long rally and high valuations. But it's not all bad news. Some regions and sectors are still gaining inflows, and many are simply moving their money into bonds, gold, and safer options. For everyday investors, this is a reminder to stay calm, diversify, and think long-term. Outflows don't always mean disaster. They can sometimes open doors to better opportunities. If you found this video helpful, don't forget to like it and subscribe to our channel, Financial Success Hub, for more simple breakdowns of big financial news. Your support helps us bring you more insights that make money topics easier to understand. And we encourage you to check out the free goodies and resources in the description of this video, which include beginner-friendly investment guides and fund trackers to help you make smarter choices. Thanks for watching, and remember, markets may move fast, but smart investing is always about patience and perspective.